Look, guys, Washington just crossed the line. Deficits and spending have become so large that the bond market is now being weaponized, and the central banks have no choice but to fall in line. This is fiscal dominance. For investors, this changes everything. It means interest rates, liquidity, and even inflation are no longer tied by Powell's policy tweaks. In fact, they're being set by the sheer size of deficit spending and Treasury auctions. And this means your portfolio is now held hostage by fiscal math, not monetary theory. In this video, I'll explain what fiscal dominance means, why deficits are the hand holding the markets right now, and what this means for gold, Bitcoin, and bonds in the months to come. Look at this, guys. The US is running 120% debt to GDP. That means as a business, the US is losing 20% annually. This is still with inflation at 2.5% and unemployment teetering around 5%. That's unheard of in times of peace. And yet still, Treasury buybacks are happening as we speak. And this is why it matters for you. If deficits are now the primary setting for market regimes, then every auction and every Treasury move is a direct signal of where liquidity is going to flow next. If you miss this, you miss the pivot point for gold, Bitcoin, and risk assets entirely. Stick with me through this video because the next few charts will make fiscal dominance impossible to ignore. Let's get into it. Off the rip, guys. Deficit spending is the equation and fiscal dominance is the answer. Here, this chart shows the top 5 expenditures of the US right now. So the biggest one, we have Social Security, Medicare, defense, and then number 4, guys, is interest payments on the debt alone. And right now, what the US needs to do is cut spending, is cut costs as much as possible. But here's the thing. They can't cut Medicare, they can't cut Social Security, and they sure as hell can't cut defense spending. So the next one on the list, the biggest one they can cut right now, is the interest payments. However, if you haven't noticed, Powell has been late with rate cuts, and rates are far too high for what the US government needs right now. This is why you've seen Trump and everyone on the administration bash Powell in the media recently for keeping rates too high, too long. But this is where it gets interesting now. Powell is finishing up his last term as chairman at the Fed, and now the Trump administration has the ability to appoint a new chairman. Having this ability, obviously, they're going to pick somebody that aligns with the goals they need, aka that will cut rates on demand to support the government, which has led to a social media frenzy, articles posted in Bloomberg, all of which discussing the Fed will soon have a third mandate. The Fed has not been given a new mandate in over 100 years, guys. This is the first time in over 100 years the Fed will now have 3 mandates: price stability, employment, and now the third mandate is helping the government finance its deficits. Here's a screenshot from the actual article. Guys, yield curve control is coming. And what yield curve control means, 1, the Federal Reserve, the central bank, will now control the short end and the long end of the curve, in turn leading to a less and less free market. And second, what this means is that the 10-year rises above a certain threshold, say 2.5%, then the Federal Reserve will have the green light to print as much money as possible, to buy as many bonds as possible, to suppress the yields below that threshold. Why do they need this? So the government can cut interest costs and spend less on interest payments. We saw it in the chart before. Interest payments are the fourth largest expenditure of the US government. Now, many other articles from Bloomberg and other people floating online are very upset about this, mainly coming from people sitting on bond desks that have done very little for society over the last 20 years and have just gotten rich running basis trades and holding bonds while just sitting on their butt. And now, due to the talk of this third mandate, they actually have to do some work. What this means is that if long end suppression, yield curve control becomes real, which it will be, it has to be, bondholders will get smoked. They've already been getting smoked. But when real rates go negative, those guys at the bond desk running basis trades will lose so much money and will trigger massive flights into quality risk assets and neutral reserve assets like gold and like Bitcoin. Right here, we have 10-year overlaid with gold price. And what you can see when the 10-year slumps, gold usually catches a bid. Because if these guys running basis trades can't make any money with bonds, they will allocate capital to the next safest asset, which is usually gold. Next chart, it shows something similar, just two different metrics. We have the DXY, the US dollar against Bitcoin. Same thing, when people sell dollars, when the dollar is weakened, when inflation runs hot, when yield curve control is happening and central banks are printing money due to fiscal dominance, the dollar will fall. Bitcoin catches a bid. This has to happen, guys. We need to understand that this has to happen. This is the fourth largest expense of the US government, and it's the largest one they can cut through fiscal dominance and yield curve control. They will suffocate bonds, they will print the money, and they will run the deficit lower. For you and I, for retail investors and people just trying to stay alive, do yourself a favor, get your money out of fiat, get your money out of crappy bonds. If you're in Canada, get out of GICs, pension plans, all of that. Take control of your finance and buy some hard money. Buy some hard assets. Buy some gold, preferably buy some Bitcoin. If you guys enjoyed this video, make sure to hit that like button, drop a comment down below. As always, hit that subscribe button. Catch you guys in the next video.